I never see an exit as a success criteria. What drives me is always building something. I'm a small company sort of guy, whether it was my own or was something small, with the founding team. I think that was sort of what I was looking for.
Robin and I were working together at Ventures West. I was an entrepreneur in residence there, Robin was a partner. And we were looking at the model and believing that there was a better way to do venture in Canada. So we both left Ventures West and we formed Basecamp Labs. And Basecamp Labs was a self-funded entity. And we got involved with Push Life and Chango, and the rest is sort of history.
We met at the early stages. It was early in Push Life and it was early days in the Basecamp partners. And we just respected each other as a group of guys that could help build something.
This is really about finding founders. You think you're going to help in the early stages be successful, and then you're comfortable with all the money you've given him to back away and let him, drive the bus and take it forward.
We could probably both say it at the exact same time. Ray.
Ray is pretty exceptional. He had great vision from early days that hasn't wavered much at all. And as we meet people, new entrepreneurs, new founders, even with great ideas, Ray really set a high bar.
One of the things that I'd mapped through the mid-2000s was just smartphone penetration in developed countries, North America and Europe. The reality of today is that global handset distribution is weighted towards 80% feature phones and 20% smartphones. And so there's sort of a greenfield opportunity right now with emerging countries that just don't have the kind of smartphone penetration we have here. So that's an opportunity that I really keyed in on.
In the early days, the whole company was hinged on a two-way sync functionality. And we had a phone call with one of the carriers early on, and we pitched it as this two-way sync product, and it was better than anything out there, and it would do this and that, and it just was a complete flop. And went back to the drawing board and came back with, this is an iTunes style store for mobile, and that you enable the carrier to finally get into the game of selling content the way iTunes is doing that with their iPhone on your network. And when they got that, we went into that pitch and it was immediate. It flipped the thinking.
We truly leveraged the capabilities and the connectivity on a phone to immediately pull down song lyrics, biographies, artist pictures, news, concert listings, and really make the platform stand out. Some mistakes are really costly to fix in the long run. So hiring is done through references and people we know. There's always the option of using headhunters, and you do get good people through them, they're just expensive. Most people coming to us are looking for autonomy, control, and the ability to make a difference. And usually those are the kinds of people you want to hire anyway. Our first employee definitely had the right skills, but there were some signs that at an interview that he may not really necessarily be the kind of guy that would fit into a company like this. Ignored that intuition and just kind of said, look, the skills look right on paper, so it should be fine. And that was a disaster. We had to let this person go. And I think I'm starting to learn more that intuition is more important than I think people give it credit.
I don't think we went at it as, how do you do this as an investor? I think we went at it more as, how do we build companies again the right way? And that's where Push Life came in. It really was very influential and helped us kind of define the way we got involved very actively in companies.
I don't look at them as my venture investors. I look at them as just guys on a team helping to build something.
We sat in a meeting one day and Ray sort of looked over and said, here are the co-founders for me, Duncan and Robin. That's exactly what we want to feel like every time in the companies we get involved in.
In the next 18 months or so, as we really start moving into emerging countries and geographies that have almost no other electronics, we can allow mobile entertainment to be brought in a really cost-effective manner. It's not saving the world or curing cancer, but it's one of the ways that I think we can address emerging markets and deliver high value at a very low cost.
So, good evening, ladies and gentlemen. Welcome back to Entrepreneurship 101. For those of you who have been following the news, quite recently Push Life was acquired by Google. I don't know if the dollar amount is public, but it's pretty substantial. It's what they call a very nice exit for the founders. So, and that didn't take too long. So, good idea, good company, growing quickly, and you can really make it happen. So I always love these success stories because, and we made the video before we knew that was going to happen. So anyway, it's kind of motivating to say you really can build and get traction and really go big. So for tonight, a couple of announcements. First slide, please. New models of innovation in life sciences. That's next Wednesday, the 20th. It is a breakfast meeting, 8 till 9:30 down here in the auditorium. The cool thing about this, it's a panel. Our own John McCullough is moderating, and Director of R&D from Pfizer, CEO of Infonaut, CEO of the Center for Commercialization of Regenerative Medicine, and Al Edwards from the Structural Genomics Consortium, talking about things like open innovation. Everyone knows open source code and software. There are all sorts of really intriguing models, crowdsourcing on ideas, open innovation, really trying to look at cutting costs in developing new pharma, new drugs in life sciences by innovative ways of sort of capturing ideas. So I think that'll be a great start to your Wednesday, and of course you will finish the Wednesday in the auditorium here again for E101, and next week will be Barry Jacquer talking about raising money, which is a logical follow-on to tonight's talk, which we'll get to in a moment. So the next event I want to billboard is the best practices for social tech, for social change. And you guys all know I'm way out of my depth in this. This is how organizations and social change makers plug into social media and Web 2.0. For those of you who understand these things, this, I'm sure, will be very attractive. Meanwhile, I am contemplating whether or not I should join Facebook, but probably not. Okay, so to tonight. Tonight's lecture is Terms of Investment. Delighted to welcome back a speaker, again, a former speaker from E101, Shirley Speakman. Shirley is a colleague of mine in the Mars, in the Investment Accelerator Fund that is managed here out of Mars. She's the Director of Investments for the Investment Accelerator Fund. It's a $27.5 million VC fund, does early stage seed investments in startup companies like Push Life, which we didn't, but anyway. Sorry?
Thanks for reminding me.
Yeah, well, hey, we've got great companies in that portfolio anyway. So Shirley's job is really to look at companies that come in, evaluate them, shepherd them through an approvals process that involves an external panel of investors to ensure independence and transparency. When they're approved, structure the deal, make the investment, and then to run by the side of the company and help the company succeed. So it's kind of a soup to nuts job when you're investing in small startup companies. And I can tell you from personal experience, Shirley does a superb job of that. Prior to getting involved with the IAF, she has had over 12 years working with small companies in the areas of strategy, finance, negotiations, fundraising. And I think that's what brings such value to the side of the companies once the IAF makes an investment in them. She has an MBA from Wilfrid Laurier and a Bachelor of Economics from University of Waterloo. So terms of investment, not to be confused with terms of endearment, but really the basic rules under which people invest in companies and the rules of the game. It's something that Shirley lives on a day-to-day basis. So I will turn it over to her to talk about.
Thank you, Tony, for that great introduction. I really appreciate it. When Tony asked me to do this lecture and the lecture I did last year, what I wanted to do was to set the stage. I think for you to understand the terms and conditions that a VC is asking for, you need to understand what it is that they're asking for and why they're asking for it. So I've titled the slide, the presentation, What Do VCs Want? And I find that when I'm trying to bridge a gap between people and try to bring people to a common understanding, it's important to find a common basis of understanding. So understand that you want money. I mean, how many people in this room don't want money, right? I'm pleased to see that there's no raise of hands. And you know what? You have something very much in common with VCs. They want money too. But the difference between you and a VC is that you want money. Oh, let me go back one. But they want big money, like really big money, okay? And it's important for you to understand why they want really big money. They are motivated by the very nature of their instrument, the very nature of their model. It impacts everything that they do, how they think, what they ask for, and the terms and conditions that we'll talk about more specifically later on in the presentation. And what I want you to understand is that because of how VCs are structured and the return expectations that they have and the terms and conditions that they're going to be asking you for, most companies aren't VC-able. So let me just repeat that. Most companies are not VC-able. And it comes down to those factors. The big money return that they're looking for, the fact that you might not like their terms and conditions, but that doesn't mean that you don't have a good business or that you can't be successful. You just can't achieve those return expectations that a VC wants. But if you decide that you do have the big money return expectation, you can meet that threshold that a VC is looking for, and you're willing to accept the terms and conditions that we'll get into later, then I hope that tonight helps you, better equips you for the negotiations and an honest discussion with the VC. So the VC world is all about kissing frogs. So I know that you're all human beings, but frankly, I see a whole lot of frogs out there in the audience. I have to kiss a lot of frogs to find my prince, okay? Not all of you are going to get me the return that I need as an investor. And in fact, I have to kiss about 1,000 frogs or companies in order to find 10 investments that could potentially get me the big money returns that I'm looking for. We have a rule in the VC world. It's called the 262 rule. So 2 of my investments, of the 10 companies that I believe when I make my investment will be spectacular successes, reality plays out very differently. 2 end up being horrible, horrible, horrible losses, like complete and total write-offs. 6 end up kind of living in the land of the living dead, which means I have to rely on 1 or 2 companies in my portfolio to give me the return that my investors expect. So what it comes down to is that my winners have to pay off for my losers. So when I'm taking a look at a startup, that means that I need a 10 to 12x, a 10 to 12 times return in 5 to 7 years to meet not only my investment thesis, my investment time horizon, but to give the people who invest in the fund the return that they're looking for. With existing companies, we can be a little bit more flexible. We only look for a 5 to 7 times return in 4 to 5 years from the point that we make that investment. So what it comes down to is that VC is a very high-risk game, and high risk requires high reward. So let's just go through some of the numbers to play out that 262 rule. So if I have a $100 million fund, which is, we're not Sequoia here, we're not doing a $600 million fund, but let's say it's a $100 million fund. I have to give my investors a 20% return in about 6 years. So that means I'm looking for a 3-time a target exit value on my portfolio of $300 million. Pretty simple math. I think pretty much everybody in the room can figure that one out. The way the 262 rule plays out, you know, that land of the living dead and the failure and the 2 successes, means that I get a 0 return on 2 of my companies. You know, let's assume we get my money back, assuming I invest $10 million in each of these companies. So I get I get 60 million times 2 back, so 120 million. That means those last 2 companies have to give me $180 million return. So that comes down to a 9 times return. So you see how, if that's the VC model, that's going to drive a lot of expectation from the VC perspective. So what does that actually mean for you? That means a company that doubles every year in revenue isn't enough. Like, think about that. A company that doubles every year isn't enough. And every opportunity that I look at, that I invest in, I have to believe can get me that at least 9 times return, but preferably the 10 to 12, if it's a startup. So let's take a look at how this plays out. So there's a granddaddy fund in California called Sequoia. It's been around forever. It's had multiple funds, and it's done its job very well. They invested in a company called YouTube. I'm sure you're all very familiar with it. They exited YouTube to Google. Well, it was sold to Google for $1.6 billion. I love that word, billion. It's a great word. Sequoia actually invested $11.5 million. They own 30% of the company, so they ended up getting a $495 million payoff. That's a VC return. That's 43 times on that investment. That sounds pretty impressive, doesn't it? 262. The rest of that portfolio, zippo. 0. Right? Pretty impressive. And that's the granddaddy. That's the guys who know what they're doing and been doing it for a long time. So let's talk about some expectations that I think are realistic for you. It's going to take you about 6 to 9 months to raise capital. So I highly recommend that you don't go out looking for money if you need it next week. You know, we're not the type of people to come to if you're looking to meet payroll. And you might ask why this takes so long. But let me ask you this question. Would you write $1 million check to somebody you don't know? No. You know, somebody comes knocking on my door, I'm not going to write a check to them right away. I need to take some time to get to know them, to see if what they say they are going to do, they do, and to see if their expectations are at least close to reality. Are they starting to pan out correctly? So if you told me you're going to have a customer in 3 months, guess what I expect to hear from you in 3 months? I expect to hear that you've got a customer. And that's what I call my say-do factor. If you're going to say something, make sure you do it. And the whole point of this dating period is so that everybody gets to know each other. The VC gets to know you, but you also have to get to know the VC. And so here's my personal recommendation to you. Make sure you spend as much time getting to know the VC as he's spending to get to know you. It's a mutual dating period. If this actually ends up in a consummated transaction, you're going to be essentially married to this person. And they're going to have a whole lot more power in the relationship than you are. So make sure that you can live with the person that you're going to be dealing with, or more importantly, with the fund and its reputation. To make it an efficient process, make sure you know who at the fund makes the decision. If you're always talking to an analyst, you're not moving through the process. Eventually, you want to be talking to the associates and maybe a partner. So, you know, start understanding what the messaging that the VC is giving you happens to be. Understand where they are in their life cycle. A typical venture capital fund has a 10-year life. So you don't go knocking on the door of a VC fund that is 6 years into its life. They're just not, they're not going to be able to get the returns that they expect out of you. Or, to be honest, they'll have terms and conditions in their term sheet that you might not like. Try to understand what their last deal was. Ask them what the last couple of deals were. Because a fund might start out targeting a certain area and may morph. So understand what their last deal was. It demonstrates what their appetite happens to be. And one of the neat tricks I've often given some of my CEO friends is that check out the website. You know, most VCs will actually list the companies that they've invested in. And you can always just pick up the phone and talk to those existing CEOs. Find out what the investor actually is like to deal with on a day-to-day basis. Understand and ask, what do they like to deal with in good times and in bad? Because many of the terms and conditions that we're going to talk about later really only start to matter in the bad times and when you start not meeting your targets. Understand how much cash they have available and how much they reserve. So they'll say we'll make a $500,000 investment, but we actually allocate up to a certain amount for each investment, maybe up to $1 million or $5 million, whatever it happens to be, and how much is left, because that also impacts some of the terms and conditions that we'll discuss later on. A little tip as well for VC language, no yes. So if somebody doesn't tell you yes, they're actually telling you no. So if they're not telling you no, they're telling you no. Like a lot of people think that they should just keep going through, they haven't told me no, so they're still really interested in investing. Well, this shouldn't take forever, okay? And as I mentioned earlier, make sure you can live with them because you're in with them till exit do you part. And that's a long time. So, what's the first step in this? So you've gotten past the gatekeepers, you've made it past the analysts, you've made it past the associates, you're now talking to a partner, they've done their evaluation, they actually think that this is a good company. What's the first step? The first step is a term sheet. It says, basically, we're interested in investing in your company, and these are some of the general terms and conditions that we're interested in providing to you, or the conditions on which we'll invest. This is just a, hey, we're interested in investing in you. This is not the offer. This is not the legal documentation. And in fact, it's a non-binding offer to invest. This might not actually come to fruition. And there's a lot that can happen between the time you get issued a term sheet and actual execution of documents. And every sophisticated investor that I know uses a term sheet. So it's something that you should expect because it also provides a basis for which negotiations to occur. You know, you want to make sure that you understand what those terms and conditions are going to be, what their expectations are. And I've come across, you know, basically 4 terms in a term sheet that don't cause anybody any heartache. And those are the company name, the name of the investors, how much is being invested, that's a good one too, and the date of the term sheet. Pretty much every other term and condition that's in a term sheet in my history has caused somebody heartache. But the point is that all of those other terms and conditions are there to mitigate the downside risk for the venture capital investor. And that's why I want you to go back to doing the due diligence on the VC and understand how they react in good times and in bad. The first issue that always causes people heartache is valuation. You believe your company is worth X, and the VC believes that the company is worth substantially less than X. And some people will argue that valuation can be done with discounted cash flows. Well, it kind of helps to have cash flows to discount, would be my argument. You can do it on a multiple of revenue, if you have revenue. You can do it on a comparables basis. And to be honest, as a VC, we do look at the other deals that we've done, and we try to position companies relative to each other. But that also comes down to the fact that you are you, and they are they. And there's never a company that is exactly the same. Now, I'll give you a little plug here for the IAF, because that's the company that I work with, the Investment Accelerator Fund. Our standard instrument is actually a convertible debenture. And that means that we make an investment in a company. on the understanding that we will convert our investment, which is essentially a loan-ish, it's a loan, and it will convert at the next round of financing at a discount, and we take an equity piece of the company. And we do that for two reasons, because at the stage that we invest in, it becomes extremely difficult to determine valuation. So using a convertible debenture instrument allows you to say, let's just put off trying to figure out what the valuation is, because we're probably not going to be able to come to terms on what that should be. But I need compensation for having taken the risk of going in early. And I typically take an interest on that convertible debenture as well, and the equity as well. So those are to compensate me for going in early. Not everybody likes that type of an instrument. Some VCs use them, some angel investors use them. It's our standard document at the Investment Accelerator Fund. But if somebody else is willing to negotiate valuation and establish price, we're happy to play along in that little sandbox as well. The next one is the company's growth forecast. Every company that I have seen has this projection. Tony's probably talked to you about the hockey stick. That's the hockey stick. So you absolutely believe that. Otherwise, you wouldn't be putting it in front of me. But in as much as I have the 262 rule in the VC world, the reality is in the company, in the number of companies that I have invested in, I have never, ever seen a company execute 100% to plan. Never. And that's not because you didn't try or you didn't know what you were doing. It's because there's stuff that's outside your control. So to mitigate my risk, the first thing that I will do is I'll rationalize your forecast. And that's a polite way of saying, I think it's basically going to take you twice as long and twice as much money to get to where you thought you were going to get at any particular point in time. Your rule of thumb, my rule of thumb, that's just what I do. Then, over top of that, I say, we're going to have to raise more money. So we're going to have to do the seed round, which is probably something that I'm involved in, and then we're going to do a Series A, and then we're going to do a Series B, and then we're going to do a Series C. And at each of those points, we hope that there is an increase in valuation. So the goal is to actually, VCs will honestly believe that at the early stage, they overpay for the companies that they invest in. And then that green line crosses the blue line, and that's when we start getting our deals. We actually start underpaying for the value that you've created. So it goes back to that earlier comment that I made about make sure you know how much a company, a VC, has in reserve, because he's going to be investing early, and then you're going to want him or her, you're going to want her to participate later on downstream. Okay? Hope that makes sense to everybody. Then the next issue of contention becomes the instrument that a VC will actually use to make their investment. If you guys have structured a company, you've probably done it with a common share structure. Everybody's treated equally. Nobody has special privileges. If something happens, we're all in the same boat. VCs don't invest in common, just so that you know. And there's a rationale for that. The rationale is that the entrepreneur, the founders, are at the company on a day-to-day basis managing the organization. So the instrument that a VC will typically use, and there's some debate in the industry, I'll be honest. There's some guys that actually do believe in taking common shares, but those guys are few and far between, so don't be surprised if you see a pref share structure. A preferred share structure basically says, if all things go badly, and we liquidate all of the assets, and we pay off all our debts, and there's only equity left, the preferred share gets paid out before the common share. Okay, it seems kind of reasonable to me. The next big issue is IP assignment. Venture capitalists will not invest in a shell company. You'd not believe how many times I've been approached by an entrepreneur saying, I have this intellectual property and I'm going to allow this other company that I want you to invest in to use the intellectual property. I'm like, so you're asking me to invest in the company that doesn't own the intellectual property. So what actual asset does this other company actually have? So expect to see a clause that says all intellectual property will be assigned to the company. And I think that, in my mind, that's actually a reasonable term as well. You're asking for their money, what are they getting in exchange? And it's not just of the founders. We want to make sure that all employees, all the intellectual property that your employees are creating is also is assigned to the company. Same with consultants. There's a little nuance when it comes to students and academic institutions. So sometimes what happens is that a company will obtain an exclusive worldwide license to intellectual property that is created at an academic institution, and that's provided via a license. One of the interesting things, or one of the conditions that a VC will want to see is an actual assignment of the intellectual property after a certain point, if it's an exclusive license. So let me try to explain what that means. It means that if at a certain point company X has paid $20 million in revenue or royalties back to the academic institution, the company probably should have the ability to just have the IP. That's one of the conditions that a VC will look for in the licenses that they see with academic institutions. And I'll just go back to that initial point I made, which is try to definitely avoid any convoluted intellectual property structures. Because one, it gives somebody like me a reason to say no. I mean, I could invest in a company that's got a nice, clean, crisp structure, easy to understand, or I could invest in a company that takes a nuclear physics engineer to figure out, what lands where and when. So if I'm kissing 1,000 frogs, don't make it a warty frog. The VC investor is also going to want to see key employees covered by certain terms and conditions. So I'm investing in a company, and beyond the intellectual property, I'm also investing in you guys, the founders. So you're going to want to bet that there's going to be an agreement somewhere that says, if I invest in you and this company, you're going to be precluded for a certain period of time from leaving the company and starting a competing company. And I think, again, if I was to say, is that reasonable? I think that's pretty reasonable. Why would I invest in a company that you're going to end up competing with? Along with that becomes the non-solicitation clause. And that says that in addition to not going out and starting a competing company, you're not going to go out, start a competing company, and then try to solicit the best programmers that we actually have at this company. And you're not going to try to solicit our customers. And it's the point on the IP assignment, that's the employee agreements is typically where the IP assignment clause is covered off. ESOPs, an employee share ownership plan. The reason that a VC wants to see this is we want to make sure that everybody is motivated in the same direction. So we want to make sure the founders are motivated. We want to make sure that the employees are motivated. And it's a really important way in a competitive market to attract talent. I mean, you all are sitting here because you believe that as founders and as entrepreneurs, you can create more value and wealth for yourself than by working for somebody else. And it seems to me that that's the type of person you want to hire into your company. And that's going to take typically some equity to attract, particularly at the seed and early stage, because you don't have the ability to actually attract them with salary. We typically look at a reasonable ESOP being between 15 and 20% of the share structure. I've seen it as low as 20, but as low as 12, but typically 15 to 20 is the right range. But basically, it needs to be large enough to attract a CEO, if you need one, maybe a VP of marketing or CTO, and board members. The way that a startup actually compensates its board members is through the ESOP. The one little caveat that I will put on this, and it's a philosophical thing for me, is that I don't believe that a VC should be given options for sitting on the board. I think frankly, it's your job. It's how you actually keep track of your companies. So philosophically, I just don't believe that they should be given options for doing their job. The important question for you is, does that 15 to 20% come in before Does that have to be created before the VC will put their money in, or after the VC puts their money in? And that's important because the creation of an ESOP has a dilutive effect. And you want to know who has to bear the brunt of that dilution. If it's on a pre-money basis, it's all the people who exist in the company at that moment in time. So if you're the founder, pretty much that's you. If it's post-money, then it's a shared burden. And typically it's done on a pre-money basis. In specific circumstances, I've seen it done in a way that half of the ESOP creation is borne by the founders, or a portion of it, a significant portion is borne by the founders, and then subsequently is shared by the VC investor. The next is dividends. So we have a preferred share structure. So in addition to the right to get paid out first, they also typically have a dividend attached to them. So an 8% dividend or something like that. The unique part is that the dividend shouldn't actually be paid in cash. It should, in fact, accrue over time. Because you don't want money going out the door to pay a dividend. You want money staying in the company to create value. But what will end up happening is that preferred share plus its dividend will convert on an exit. So the next big one is, of course, the liquidation preference. And the liquidation preference is probably the nastiest clause. It's the most unpalatable for founders. The liquidation preference basically says, if we have an exit, a $10 million exit, and the VC has invested $6 million, they get their $6 million out before anybody else gets paid anything. That means there's $4 million left to divide among everybody else. Now, is that reasonable? It is, in that the VC has investors that they have to provide a return to. And how do they provide that 9 times or 10 to 12 times return if they're not trying to get at least their money back on some of these opportunities? This typically takes effect when we've got those land of the living dead opportunities. You know, the ones that aren't spectacularly successful. Because if the company was spectacularly successful, I don't want just my money back. I want to participate in the economic wealth and value that's been created in a $1.9 billion exit, or whatever it happens to be. What you should watch out for here is what's called a participating preferred liquidation preference. It's a big terminology, but that basically means instead of just getting 1 times their money back, a lot of VCs would ask for a 2 times liquidation preference. So let's assume that you had the $10 million exit. The VC actually put $6 million in. They have a 2 times liquidation preference. Simple math, they get $12 million back. You don't have $12 million. They take everything. So watch out for that one, okay? Next one, anti-dilution. As I mentioned earlier, I have never actually seen a company perform 100% to plan. What does that mean? That means that oftentimes companies have to go out and try to raise money in bad markets or when they haven't actually met their targets. So that often leads to what's called a down round. So you might have actually gone out, I invested at $1 a share. We have to go out, we have to do a down round. So the new market investors aren't willing to pay $1 a share. They're only willing to pay 50 cents a share for the same company. So a full ratchet anti-dilution protection clause says that I invested at $1 a share. The new money is coming in at 50 cents a share. You have to issue me the number of shares required to get me to an effective price of 50 cents a share. That creates dilution for the founders. The other way to do that is by taking a weighted average of the old issue price and the new issue price, figuring out what I should have received at that weighted average price per share, and then issuing me the number of shares required to get me to that price per share. So that's a clause that you've just got to decide if you're willing to accept or not. and if you can get it from a full ratchet to a weighted average. That's really the point of negotiation. Redemption. Let's go back to doing your due diligence on the VC fund. Understand again where they are in their life cycle. Because this clause says that in any transaction that I've negotiated, it basically says that in 5 to 7 years, I have the right to sell my shares back to the company. So I'm a new investor, I'm waiting around, I'm not seeing an exit come by. So what do I have to do to get my return that my investors are looking for? I have to find a way to get out of the companies. This is a way for me to get out of the company, to sell my shares back to you. If you don't have the money to buy my shares back, I can force a sale of the company. Okay? And all I'm looking for at that point in time is to get my minimum investment back, my principal and my dividends. And that's why knowing where a fund is in its life cycle is really important, because that impacts the redemption clause and the clock ticking. Other rights and privileges. This is the power of other people's money. I like calling it that, the power of other people's money. And that's why it's so important to get to know your VC and how they act in good times and in bad. These other rights and privileges don't tell you what to do. They don't. They just say, you can't do this, you can't do that. And if I know any entrepreneur, that grates you guys like you wouldn't believe. So make sure that you know your VC and you understand what they're asking for when they ask for these other rights and privileges. And what are some of those other rights and privileges? Well, basically it comes down to approvals. Approvals over things you can't do without their approval. Typically it's about a 66 2/3% threshold, so somewhere between 60 and 66 2/3. So you can't change the nature of the business. You know what, I invested in a semiconductor company, I didn't invest in a furniture company, so no, we're not gonna change the nature of the business without my approval. We're not gonna change the capital structure of the company, which actually, and what that means is that, you can't go out and raise more money without my approval. I need to have approval over your business plan and your operating plan. I need to have approval over changes in key employees, which is typically a defined term. We typically name who the key employees are. It's not everybody in the company. It's typically the founder and the CTO in a technology company. The creation, if an ESOP wasn't in existence when the original investment was made, then we have a nay say over the creation of an ESOP, because that has a dilutive effect on my investment. And the approval of any unbudgeted expenditure over $5,000. So let's just remember what that means. That means it's not any expenditure of $5,000. It's an unbudgeted expenditure over $5,000. So I've approved the budget. I know what the budget is going to be. Now you've got to come back to me and say, I've got to go to a really important conference or trade show in Europe, and that's going to cost us $10,000. It wasn't in the plan. Do I have your approval to do that? So that's the type of stuff. Now, point of negotiation is that $5,000. What's the right unbudgeted expenditure number? And of course, any non-arm's length transactions. So you want to hire your brother to do your accounting? That's something that I got to approve. Information rights. I've got an investment to manage. In order to effectively manage an investment, I need information. So a VC will typically look for monthly prepared financial statements, and I want them typically between 20 and 30 days of month end. And frankly, if you're running a real business, that's the type of thing you probably have already, because you have to manage your business. Quarterly financials that talk about budget versus actuals, and an explanation of why the difference. Board material. There is nothing that bothers me more as an investor than getting packages of information as I am walking into a board meeting. I want to be able to get the information at least a week in advance of the board meeting so that I have time to review it and frankly, to provide a valuable contribution to the meeting. You know, it doesn't do anybody any good for me to be reading through the material and still trying to make an important decision, like some of those approvals that require my approval. I want to see a yearly operating plan 30 days in advance of the start of the fiscal year. And again, I think that's frankly just good business practice. You should have an operating plan, something that you've sat down and you've thought about, and you say, this is what I want to do for the next year. Share restrictions. This is another area that many founders and entrepreneurs really don't like. You're a founder, you own shares in your company. Once you bring in other people's money, you typically lose the right to sell those shares at your discretion. So you need to go back to your investors and say, you know what, I need to sell some of my shares. Oh, it's great, there's no really bad reactions. That's good. Okay, typically I get a bad reaction to that. There's also drag along, and a drag along is if X% of the shareholders in the company receive an offer to sell their shares and they decide that they want to sell the company or their shares, everybody else has to sell. The flip side of that is that if I've received an offer, or if you as a shareholder have received an offer, I as a VC can put up my hand and say, I want to participate in that sale on a pro rata basis. And the reason I need both a drag along and a tag along goes back to my need to get out of the investment. A VC isn't in this game or in your company as an investment for the long run. They have that investment horizon and they have to provide a return to their investors. A VC is going to definitely want to see a board. And you know, if you've got a company structured, you probably already have a board in place. It's not the board that the VC is going to want. It's typically friends and family, people that you know. Expect the board to have to change. Typically, a VC board is 3 to 5 board members. I typically see 5. So two founder nominees, 2 investor nominees, and the third is an independent. And what's up for negotiation in figuring out that independent is how that person gets nominated and installed. So is that the VC nominates and you get a chance to approve? Is it you nominate and the VC gets to approve, or is there some sort of coming to a mutual understanding? One interesting suggestion that I have for board meetings when you have a VC is that they will have a caveat that says a board meeting is not properly constituted, so therefore no decision can be made unless I'm sitting in the room. Which makes sense if you think about a board being a way to manage and monitor your investment. What I would put back is that, okay, you missed the meeting. We've constituted a second board meeting within a week or a couple of days. If you missed that meeting, your problem, not ours. We still have business to do. So the second meeting can actually occur without the VC present. Typically a deferral of 1. And the term sheet, I'll go back to the beginning, is non-binding except for, so I just kind of lied just a little bit. It's non-binding except for the very last clause, which is acceptance and exclusivity. There's a deadline for you to sign back the term sheet. It's typically 3 weeks, maybe a month if you can negotiate that. So I would suggest that if you're actively fundraising, you'll probably have a couple of candidates in the hopper. If you get a term sheet, you've got a short window to try to get a different deal or a better deal. Because once you sign back that term sheet, you go into a no-shop period. And that means you have to stop talking to everybody else. And that protects the VC. It protects the VC and gives them confidence to make sure that they can start incurring all of the expenses of documenting the transaction. And I'm going to ask you to be careful what you ask for. If you demonstrate that you don't understand the process, you don't understand that there are some typical terms and conditions that every VC is going to look for, if you're difficult in these negotiations, then it sets the wrong tone. And in part, that's why you get a lot of term sheets not ending up in a consummated deal. And the one thing I want you to take away is that there's a golden rule. He with the gold makes the rules. And I think on that, that's it. So I'd be happy to take some questions. Yes.
I have two really quick questions. Firstly, are there any industries that VCs typically will never invest in, like the returns just do not pan out? And secondly, is there a manual, like an application manual that I can read?
There's some absolutely great, so let me answer your last question first. There's some great online resources, and Mars has some fantastic resources. So I'd suggest you go there. The Kauffman Foundation is another place that has some great resources. So, but definitely the Mars website is a great place to start. Are there industries that absolutely never get funded yet? Well, I can never say no, and I'm hesitant to say absolutely not. But there's some areas that VCs just don't typically play in, like retail, because it just, go back to that, does it give you the big bang returns that a VC will expect? And that's really the caveat.
Thank you very much for your presentation. It was beautiful.
Oh,
You took a lot of complex information and compressed it so well. Thank you very much.
Oh, thank you. I appreciate that.
I wanted to actually go to the accounting side.
Okay.
If you have a great income statement and balance sheet, when we're looking at the variable cost and the fixed cost, is this a part of the VC's evaluation? And the second question would deals with the preferred stock. How would you, as a startup, make the negotiation with the VC when you don't have a contract or you actually haven't went public yet? So if you can give us some light on that.
Sure. So in answer to your first question, yes, the variable costs and the fixed costs absolutely come into consideration because it deals with a couple of issues. One, it deals with scalability and the amount of capital that it's going to take to get the company to scale. So how much fixed costs, how much capital, how much CapEx are we going to have to spend, and how is that going to impact how much money we have to raise along the way, and how diluted am I going to get? So yes, that does have some impact on it. The preferred share, if you're a private company, you can issue any type of share that you want, so it doesn't really hinge on whether you're public or private.
Thank you.
You're welcome.
Hi, great presentation. I really enjoyed it. My question is, how do VCs look at companies that work primarily with offshore resources? So this is in terms of...
do you mean like incorporated offshore, or do you mean like oil and gas offshore?
Sorry, I guess it's incorrect terminology. Say my developers are all in India.
Right.
And in terms of who owns the IP, you know, I believe I own the IP, but I'm not exactly sure how you guys would look at that relationship.
Some look at it positively because it's a very inexpensive way of developing software. Others don't. And you
okay, but it wouldn't preclude me from seeking VC investment.
But it's all part of that due diligence and trying to figure out
Sure.
what fund you should be going to. Don't go to, check the website, figure out what companies they've invested in, and figure out where their developers are. And if there's any companies in their portfolio that they followed that business model, then those are guys who are comfortable with it. If you go through their 30-odd companies that are software and you don't see any of them that have an offshore, then chances are you shouldn't be talking to those guys.
Sure. Thank you.
And poll around. Find out who is comfortable with that model.
Is it okay to ask VCs these kinds of questions before you get into like a negotiation?
I wouldn't. I'd do the homework beforehand, ask other people.
Okay, thank you.
You're welcome.
Hi, first of all, thank you for the presentation. It was very helpful for us. You mentioned that VCs are looking for big money. Is there a benchmark or standard amount that we can say is, you know, the minimum amount they'd be looking to invest in a company? Like if I'm looking for a couple $100,000, am I wasting my time going to a VC? Should I be looking for $1 million? Is there such a benchmark?
Every VC has their own appetite. Typically a VC is larger than a couple of $100,000. But it will depend on the VC. There's some corporate VCs who are willing to go in earlier, take a risk because they see a strategic implication or a strategic benefit of the technology downstream if it proves out. I would just suggest that again, as I said, there's most VCs list their companies on their website and just check them out. You can ascertain that pretty quickly with some good thorough due diligence.
Thank you.
You're welcome.
Hi, thanks again for your presentation. My question is directly towards the company you work for, which is the Investment Accelerator Fund. And you mentioned that it's good to know where the VCs are or what they like to look for.
Yep.
So that would be my question towards
Sure, it's actually a very good question, and I appreciate the plug. So the Investment Accelerator Fund specifically looks for technology-rich opportunities. So historically, we've looked for opportunities that have patents, that are patentable, so the technology is patentable, or we take a look at the opportunity and say, there's enough of a technology differentiator and an advantage that we're comfortable with it. But when you take a look at the companies in our portfolio, and we have 36, you'll get a sense that they're all very technology rich, if that helps you.
Okay, so what were some, just from those companies that you have worked with, what is some of the experience you've had in terms of the bad times, and what is your main company that you might use as a marker for other investments?
Well, we actually invested in a Mars company called Sysomos. So that would be my win. And we went in there, we invested a small amount of money, worked really hard alongside the other investor that came in after us, and created a company that had a phenomenal return from my perspective and gave us a great return. It was not easy. There's a lot of hard work. As you all know, a lot of hard work goes into building companies. And when you introduce a dynamic where you've got other people having more power in the relationship and starting to control your day-to-day actions, it creates some challenges. So it's one of the things that I always find a bit challenging in any of the investments that I've made.
Okay, thank you.
You're welcome.
Hi.
Hello.
My question is would it be useful for the entrepreneur to know a little bit more about the VC? Based on that one, what you said, they failed 4 times before, so probably they carry forward some capital losses. And based on that one, can you figure out their break-even point with your company?
I would just assume that all VCs do 262 and figure out where they are in their life cycle and how much money they have left. It's the easiest threshold as opposed to trying to figure out some of those other accounting.
Yeah, but you can carry forward those losses, right?
I'm really not on the accounting side of the fund. I'm more on the delivery of performance.
Yeah. Okay, thank you.
I mean, Shirley said something that I think is very important. Each fund in a private equity fund, it's a time-limited capital pool. So you get $100 million from one group, and you get out there and you invest it. If you did not make a lot of money, so if you said, they've had 4 of these funds, if you didn't make a lot of money in your first one, you never get a second one. So they don't carry forward losses from one fund to another. If I think that's your question, no. They lost money,
they're not
and
make money.
You are not welcome anywhere in that community anymore.
Thank you for the clarification. Yes.
I think that's
you lose
what
money
you
on
were
fund
asking.
1, you're not getting fund 2.
Yeah. Okay, thank you.
Hi, I was wondering about key person insurance, if that's a standard requirement for you.
It's not something that the IAF typically looks for, but other VCs do depending on the stage of company. So it could be something that you should expect. But the reality is, if it's early in seed stage, I think we have more important things to spend the money on than thousands of dollars for key man insurance.
Could it be something that is then required when you hit the other tranches?
It could very well be. Yeah, once the company reaches a certain threshold, then they may require. Or more typically, the next round investor will require that as a condition of financing.
Okay, thank you.
You're welcome.
Yeah. Well, at the end, it's all about shares. When a VC comes into the game, so what would you say, how much? You will invest a certain amount of money, and this money will give you a specific shares of
right.
So what is the horizon? Would you invest so much money that you have half of the company, so you would go only for 50%?
Right.
Or
So
can you go for 20 or 10 or?
Yeah, it's a range. So that question, the answer to that question is driven off that valuation. So if I'm putting in $2 million on a company that I think is worth $4 million, then you figure out the math from that perspective. But so it depends on the valuation that gets assigned at the time that we make the investment. So that's what drives the percentage ownership as a result of the investment. So you either, for us, we defer the calculation until we have more metrics, or you get into a big negotiation on what the valuation happens to be. And then that will determine how much of the company that the VC actually ends up owning.
But it's mostly that you try to own as much as possible shares.
Oh, right? Sure. If I can own more of the company, yeah.
The risk is that if you have more than 50 shares, you can do what you want. So you can even sell everything without an investor.
Yeah,
I mean,
exactly.
It's,
if you're going to let me own more than 50% of your company.
So how could be the founders or the other people protect their shares?
The negotiation of valuation is really what it comes down to. I mean, you could try to do, funny structuring, and thou shalt not do this, or this requires a certain amount of approval thresholds. But at the end, what your question is actually asking is about valuation. So deal with it at the primary source, which is valuation.
Thanks.
Hi.
Hi.
I think the fundraising earlier portion, I noticed that your fund will go in typically at the seed stage, and you were saying that by issuing the convertible debenture and requesting the conversion at Series A, that's when you will protect yourself and determine the valuation. Do you expect to see the Series A, B, C, and the subsequent round of funding initially in the financial plan? Or is that something that you look for, and do you?
Absolutely, I want, and it goes to, I absolutely do, because I want to know what you think it's going to take to get the company to these meaningful milestones, and how much you think it's going to take to build a real business. And then I'd say twice as long and twice as much.
And do you maintain the control over when and how we actually go and try to raise the fund? In that situation?
It's one of those approvals that's required.
Makes sense.
Typically. In our structure, we'll end up, because we're converting at the next round of financing into whatever the next round terms and conditions happen to be, we'll end up having whatever they have.
Thank you.
You're welcome.
I'm not sure there's a standard answer to this, but aside from, and not that it's insignificant, but aside from funding, there was a line in there about attending board meetings. What does a VC do to direct or to guide the business besides funding? And is there a standard answer to that?
I would, yes. There isn't a standard answer because the quality of VCs differ dramatically. There's some guys who invest their money and they're passive and away they go. There are others, like the IAF, who are actually quite active in trying to accelerate the companies. So for example, I just got off the phone this afternoon with a US VC, and I ended up I'll be providing an introduction to 4 companies in our portfolio for this VC. So there's VC introductions, there's customer introductions. Here at Mars, we've actually facilitated a lot of that activity. So do your due diligence on the funds that are looking at investing in you, and talk to the other CEOs that are invested in by those investors, so you can actually verify the value that they bring to the table. And I think I have time for one more question, Tony, if that's okay.
Sure. Do VCs invest in ideas right from the get-go, or would it be better to go raise some capital, let's say with friends and family, to put together a really solid business plan before you approach VCs?
I would love to tell you that VCs invest at the idea stage. They really don't.
Okay.
In general.
Okay.
There's VCs, like there's the Y Combinator model. There's a number of models out there that are trying to break the tradition. Mm-hmm. But unless you've been a guy that they've invested in before and have made them a lot of money, walking in with a PowerPoint presentation typically doesn't work.
Okay, great, thanks.
Okay. So thank you very much. I appreciate the opportunity.